All right, let's dive right into this incredible balancing act happening right now in the aviation industry. We're looking at Delta Airlines in 2026, and honestly, this is a company operating at absolute extremes. On one hand, they are generating just record breaking revenues, seeing tremendous demand across the board. But on the other, well, they're facing immense pressure from macroeconomic turbulence, wildly volatile fuel prices, and some highly leveraged labor negotiations. So, in this explainer, we're going to unpack exactly how Delta is engineering its flight path through these unprecedented skies. Now, the sheer scale here is it's incredible. Delta just reported a massive $19.8 billion in GAAP operating revenue for the second quarter of 2026 alone. Just let that number sink in for a second. Despite every macro challenge thrown their way, their brand and industry position are arguably stronger than they've ever been, and that's driving a highly lucrative top line. But it begs the question, right? How exactly does an airline build nearly $20 billion in revenue in a single quarter? Well, to understand how they're pulling this off, let's quickly map out our flight path for this explainer. We'll be looking at 1, record-breaking revenue growth, 2, navigating severe cost headwinds, 3, the billion-dollar pilot push, 4, fleet renewal and efficiency, and finally, 5, the final financial verdict. Okay, let's jump right into section 1, record-breaking revenue growth. So let's see how this all breaks down. The absolutely crucial point here is the staggering growth in their non-traditional areas. Yes, sure, passenger revenue grew a very healthy 13% year over year to over $15.6 billion. But take a look at that other category down at the bottom. It surged by an incredible 50% year over year. It jumped from $2.5 billion up to over $3.8 billion. And this represents things like their massive tech ops maintenance revenue and booming loyalty partnerships. And you can see how this positive momentum is really building across all those non-traditional segments. They're solidifying their strongest industry position yet, and they're doing it by not just flying planes, but by monetizing their entire ecosystem. Corporate sales, they've hit record highs, with double-digit growth across the banking, tech, and aerospace sectors. So they aren't just capturing leisure travelers, they're absolutely dominating the highly profitable corporate skies. Which brings us to a really fascinating structural shift. It's not just standard basic economy tickets paying the bills anymore. Actually, a full 60% of Delta's revenue now comes from high-margin, diversified streams. We're talking about premium seating and their incredibly lucrative American Express SkyMiles partnership. That Amex deal alone brings in over $2 billion in remuneration. Meanwhile, main cabin ticket sales now only make up 40% of the pie. They fundamentally transformed their business model. But, as we know, it's not all smooth sailing. That brings us to section 2, navigating severe cost headwinds. Any pilot will tell you, you literally can't have this much lift without encountering some heavy turbulence. You've got this amazing 10 to 13% expected revenue growth acting as a massive tailwind, just propelling them forward. But it's pulling directly against a staggering reality. Delta just absorbed the highest quarterly fuel expense in their entire history. Plus, non-fuel unit costs are also rising as capacity growth normalizes, and they absorb higher crew costs. So the engine is running hot, but the fuel bill is just astronomical. To put that fuel volatility into perspective, look at this number, $40 million. Every single time a barrel of Brent crude oil goes up by just $1, it costs Delta roughly $40 million annually. When oil fluctuates wildly based on global volatility, Delta's bottom line takes direct, massive hits. This is the undeniable gravity that constantly threatens to pull their profit margins right back down to earth. Which brings us to the human element. Let's look at section 3, the billion-dollar pilot push. So right now, Delta's pilots currently average about $230,000 a year. But with competitors like United and American offering north of $300,000, the ALPA union is demanding a record-breaking deal in 2026 to reset the industry baseline. They see Delta reporting billions in pre-tax profit, and quite simply, they want a proportional cut. They're staking a claim on exactly how airline profits get distributed in this new post-pandemic era. And as one industry analyst brilliantly pointed out regarding this tense negotiation, pilots have simply never been harder to replace. There's a well-known industry-wide pilot shortage, which puts massive economic leverage squarely in the union's hands. Delta has to secure this talent to keep flying, which means their labor costs are practically guaranteed to skyrocket. So how do you combat that? Let's move to section 4, fleet renewal and efficiency. To fight back against these costs, Delta is executing some massive capital expenditure. In a single quarter, we are looking at $1.4 billion in gross capex. Delta is funneling vast amounts of cash into what they're calling their aggressive fleet renewal program. It's a high-cost maneuver upfront for sure, but it's designed to permanently counteract those fuel spikes by modernizing the machinery they rely on every single day. The strategy here is brilliantly simple, even if it's highly capital intensive. Out with the old, in with the new. Delta is actively retiring older, gas-guzzling aircraft, like the Boeing 717s and 767s, and in their place, they're deploying Rex generation models like the Airbus A220, the A321neo, the A350, and soon the Boeing 737 MAX 10. These new jets are far more fuel efficient, which drastically lowers operating costs. And crucially, they're configured with way more of those highly profitable premium seats we talked about earlier.
Okay, let's bring it all in for a landing. Section 5, the final financial verdict.
Despite record fuel costs and looming billion-dollar labor contracts, Standard & Poor's actually just revised Delta's outlook to positive and affirmed their BBB- rating. This proves they are maintaining an elite investment-grade balance sheet. Simply put, it means Delta has strong health, manageable debt, and really favorable borrowing terms. In an industry literally known for bankruptcies, maintaining this status amidst all these macroeconomic pressures is a massive, massive victory. And we can actually see their deleveraging strategy in action right here. Their funds from operations to debt ratio is projected to approach 50% in 2026 and then steadily climb toward a very healthy 60% by 2027. They are aggressively using their free cash flow, which is estimated at over $3 billion this year, to pay down debt. In fact, they've already reduced adjusted net debt by over $700 million since the end of 2025. But what you should really take away from this explainer is the underlying confidence of Delta's management. They didn't just hoard all that cash. They just announced a massive 15% dividend increase starting in the September quarter. Let's be real, you don't raise dividends by 15% unless you are highly, highly confident in the durability of your revenue streams and the bedrock strength of your balance sheet. So I want to leave you with this final thought to consider. As airlines face a pretty chaotic macroeconomic future filled with wildly fluctuating oil prices and aggressive labor demands, will Delta's strategic machinery, their pivot to premium travelers, their lucrative Amex partnership, and the billions they spent on fleet efficiency, will all that be enough to keep them climbing despite the heavy turbulence? It is a fascinating economic balancing act, and it's definitely one we'll be watching very closely. Thanks for joining me on this explainer.